According to Investopedia, reconciliation actually comes from the Latin word reconciliare. This means to bring together again. This is a fitting definition because when we reconcile, we are looking at multiple statements and making sure all the transactions come together at the end. Have you ever gotten charged twice for Netflix or maybe a song on iTunes? If so, reconciliation is a great way to check these errors. As an accounting student, this is an important tool we use, which we can use to explain the differences and discrepancies in two financial records. Knowing how to identify these errors and check statements will help you have great financial health. I will explain the importance and reasons why it is beneficial to know how to perform reconciliation on a regular basis. Reconciliation is used both in business accounting and personal accounting, and was surprisingly not considered crucial in the United States until the formation of the Sarbanes-Oakley Act. This act was basically a set of requirements that was made by for public accounting firms to follow, and it wasn't actually made crucial until the formation of this act. According to Investopedia, the major scandal that led to the formation of the Sarbanes-Oakley Act was the Enron scandal of 2001, where the CEO, Jeff Skilling, kept a lot of debt off the balance sheet so that the company would look better. And since there were no actual accounting rules in place, they only caught the fraud when one of the employees actually turned him in. Many businesses use reconciliation to check for errors within their balance sheets so that they can avoid scam and fraud just like this. For example, if a company is paying its employees, the business wants to make sure that how much is paid to the employees matches how much is actually worked. So the accountant will often check with the amount of company that was billed and the amount that is paid to the employees. As you can see, this can definitely be associated with your everyday life. For example, if a person purchased eggs, bread, and cheese at a grocery store for $1.99, $2.99, and $3.99 respectively, they can check their bills and make sure that they were actually billed for the items that they bought. And in more extreme cases, reconciliation will also help catch these major scandals. According to the 10 worst accounting scandals of all time, the WorldCom scandal was one of the biggest internal auditing scandals that was caught. The CEO at the time had underreported costs and fake accounting entries just to inflate the revenues, and the audit department actually found $3.8 million that was incomplete fraud. Needless to say, the CEO was fired. Reconciliation is also a great tool for finding errors and helping improve one's financial health. Although these errors during reconciliation can be bad, some of them are more informative. For example, if a company finds that they are billed for more than they actually paid, it could mean that the company was not accounting for hours that were actually worked, so they can go back and fix that. So it might not actually be an error, but just something that they have to go back and add in. And not only does reconciliation help find these errors, but it allows for businesses to make better decisions about their everyday business activities. In a past study by Jefferson Wells, 200 finance and accounting executives were surveyed about the importance of internal reconciliation processes, and the respondents confirmed that timely and accurate account reconciliation has become a critical internal practice for these companies. Most participants said that they've used Microsoft tools such as QuickBooks and Excel just to perform these reconciliation tasks, but there are more technology-based, customized versions as well. Overall, reconciliation is a great tool for accurate and proper bookkeeping. Mistakes in accounting can cause many problems for businesses as well as for many individuals. Although this can be a very tedious process, it has proven extremely beneficial.